With massive layoffs in nearly every sector, weakness in manufacturing, car sales, and housing, and the biggest one-month decline in the trade deficit since the financial crisis, the economic picture is not looking good, which might explain why so many billionaires are loading up on gold, including hedge fund manager John Paulson and real estate mogul Sam Zell. Bottom line, now is the time to own gold, which is why the experts at Stansberry Research just stepped forward with a major gold prediction, arguing gold could soar as high as $3,000 by the end of the year, possibly even higher. You can find out why and get instant access to their #1 gold investment today. It's not bullion, an ETF, or a mining stock, but in the past, this gold strategy could have made you nearly 50x your money. Considering how quickly the price of gold has been moving in recent weeks, you don't want to waste any time missing out on the gains these experts believe are in store for this gold stock. To get a copy of his new free report with all the details, simply go to goldmaniareport.com. Again, that's goldmaniareport.com for a free copy of his new report. Hi, this is Daniela Cambone, and welcome back to the Daniela Cambone Show. Joining me today is a first-time guest on the show, Keith McCullough, the CEO and founder of Hedgeye. Keith, it's been a long time coming. I do have to give kudos to my husband, who said, how the heck haven't you had Hedgeye on your show? And he's absolutely right. So thank you for accepting the invitation.
Well, that's very kind of you, Danny. I appreciate that. And thanks to your husband, too. That's cool.
Yes, who has joined forces here. So I'm excited to get you on because I've been following your work for a long time. So we're going to talk a variety of things here and get your take, most importantly, on the economy. But I thought I'd start with this recent news headline, which I know you also retweeted. Janet Yellen coming out saying that U.S. banks, don't worry everyone, are stabilizing after a tumultuous, if that's what you want to call it, March. On the flip side, though, we have Jamie Dimon, longtime J.P. Morgan Chase CEO, saying that the latest financial shock will be felt for years to come. He says the current crisis is not yet over, and even when it is behind us, there will be repercussions from it for years to come. So two very different takes on what's happening. Keith, what say you? Where do you stand?
Well, I think one is a political take, Janet Yellen's, and the other one is a practitioner's take and Dimon's take. And the real take is that regional bank stocks are breaking down to new cycle lows this morning. So I guess it's just appropriate that Janet Yellen said that right before the stocks got absolutely hammered.
Absolutely. And I also want to talk about kind of at the heart of your thesis and your content, Keith, is the signals that we're seeing of what you call a deep quad four recession are becoming harder to ignore. So let's talk about that, of this quad four recession, as you call it.
Yeah, I mean, our process is really focused on going from the market signals to the economic quad, and quad four being, just to define it, is when you have both the rate of change of real economic growth slowing and of inflation slowing at the same time. That's a really bad scenario, because if you have those two things happening, you have the profit decline, which we're still of the mind here that we've already actually entered a profit recession, and that leads to a credit event. I think that if you go back to what Yellen's trying to say, that she's quelled, and again, she's infamous now for saying that we're not going to have any more market events. So clearly she's at the heart of another one. But this shouldn't surprise anyone. I mean, what we essentially have here, if you take those conditional factors, growth, inflation, and profit slowing, is that you have a lack of cash flow and less cash flow and less liquidity. So, this started with a liquidity crisis at the banks, and it's going to end with a lack of liquidity. And I think that that's really the point here, and it's going to be a while. I mean, the trade here, just like, as many have famously said about liberty. I mean, I'll give you a little bit of time for peace of mind here at the expense of your long-term liberties and freedoms. And I think what they did with the banks, I mean, all that did was put a Band-Aid on something that is really structural in nature, and the regulation that is embedded therein, like coming out of it, is just going to make the credit tighter, the liquidity functions less proper. And I think that it's going to take, I don't know if it's going to take 2 years, or a couple of years, but I mean, it's certainly going to take long enough for us to remain bearish.
Okay, and one thing you've pointed out is, talking about the S&P here, that the last two times the S&P risk range was this wide was March 2022 and November 2022. You write on both occasions, investors who chased the market highs paid for it just a couple of weeks later when the index plummeted. What is this telling you here, Keith?
Well, I mean, Danny, the first thing to realize or acknowledge, which I think maybe players that are new to this wouldn't acknowledge, is that the market cycle and the economic cycle peaked, back in November of 2021. So from that point on, it's just been the beginning of a market crash and now B, a bear market. We say we're in phase 3 of the bear market, which we can get into. But the thing about bear markets is they wouldn't bounce like they do unless they were bear markets, and that's what happened. Obviously, if you go back to the beginning of this bear market, it got body bagged in January and February of last year. Then, of course, you have the commensurate bear market rally, and on that score, which we call our risk range, the widest risk ranges that we have typically are after bear market moves. So that one actually peaked on March the 18th. And then the subsequent one, after you went through phase 2 of the bear market, we've got to go through a lot here. Again, because you had the swoon all the way down to the June lows, and then you get the rally to the November lower highs, and then our risk range opens up again. In other words, there's more risk now to the downside than there has been since March. And that's largely a function of the bear market bounce itself. So, of course, the market, once again, the NASDAQ, I'm old enough to remember when it got body bagged to its lows in the last week of December. I guess a lot of people this year think it's a bull market again in the NASDAQ. That didn't take too long.
Right. And okay, so I want to talk more about the phase 3 that you see. But look, we're speaking ahead of now jobs numbers, and the market's still pricing in another rate hike from the Fed. Who knows if that will change? But how will that change the narrative for you or your thesis at all as to what the Fed will do next?
No, I mean the Federal Reserve. It's interesting. We're at this point in the cycle, and it's not my first rodeo. I mean, I risk managed the last 2 recessions. I'm that old, actually. 01 recession and the 08 recession. What happens is that the Federal Reserve is too tight coming into it, and then they have to get out of it and find their way to the rate cut side. What's interesting right now is that, again, so many people that are new to this that haven't seen the last 2 recessions for some reason think that when the Federal Reserve is actually cutting interest rates, that's like cowbell, like that's like buying Nvidia or that's chase stocks. But that's entirely not the case going back to the prior 2 recessions, because what that would mean, and the Fed's not there yet, and just to quantify it, our nowcast for U.S. GDP growth is at negative 2% growth for the next 2 quarters. So we're already in one, and that includes the first quarter. So once the Fed finally figures that out, again, I think I'm going to have to deal with a bunch of bear market rallies because there's so many people that are seemingly confused about what it means when the Fed goes from hawkish to pausing to dovish. Dovish means you're actually in a recession, and even the Federal Reserve has figured it out, and they tend to be one of the last ones to do so.
So, let's talk a little bit about that, because I think there's so much confusion and so much noise and so many headlines about recession that I feel that a lot of folks just think like they're going to, how does that transition happen? Like, is it like a finish line, or like the next day you just wake up and, oh, it's recession day, it's here. It's like they're waiting for the recession to arrive. But you're saying, no, we're already in the process of it, right? Like, walk us through it, or like, when are we really going to feel it? And maybe some people are already really feeling it, but how will we really know? Danny,
the simplest definition is that, one, you really know when you lose your job, and that's about to happen. Not you, hopefully not me. It's only my first time on your show, so maybe hopefully I'm not a one and done. But technically, no one can really fire me this time. But if you go through, like, let's just take labor. Labor is the latest of late cycle indicators. So when people say we're at full employment, that's when you should be getting concerned, because the next part is people actually do start to get fired. So we went through this in our most recent macro themes presentation, where we went through a variety of things like temp staffing, the work week in terms of hours, jobless claims. They're all going in rate of change terms the wrong way. You also had, in the ISM report earlier this week, you had the second consecutive month of what you call contraction, or below 50 on an ISM reading. So again, the third month, and that's it. It's going to be a trend. So I think that's the definition. You're going to, that there's something, and you can see this in all consumer confidence readings. In particular, if you look at the current conditions versus future index of consumer confidence expectations. And that's quite simply, again, to make it down to what a human would feel. It's like, I'm feeling like my bonus is going to be a little bit less. Then I'm feeling like I'm going to get fired. Then you actually do get fired. And then, of course, the next definition is the only difference between, it's not funny, but the definition between a recession and a depression is when your boss loses his or her job too.
There you go, and very well said. And I guess my next point is, given your forecast, the best ways you feel we should be protecting ourselves. What are sectors you like? I know one of them is gold.
Yeah, I mean, we've made a big asset allocation rotation into gold in November. So again, when we start to get closer to what you called it the finish line, that's a really interesting one because it's a hard thing. Everyone wants to call the bottom, but I say it's, picking these bottoms is a very stinky business. It's not something I try to make a habit of. But again, the bottoms are processes, not points. And when we went bullish on gold back in November, it was quite literally saying, okay, look, our Q1 and Q2 2023 numbers for GDP are negative numbers. So we want to get long gold when that happens, because the real reason to get long gold, as most people know, is when real interest rates and nominal interest rates for that matter have peaked, roll over, and start to break down. So when you look at anything that we've allocated assets to, it's not just gold. It's essentially what I just said, which is duration. So whether it be TLT, which is a 20-year Treasury ETF, IEF, which is 7 to 10 year. We're long Nancy Davis's ETF on longer term duration, which is BNDD. We have gold miners, GDX. We have platinum, PPLT. We have silver. So we have actually on a, not like every day is your day. I mean, today's been a good day for us because we basically had back-to-back March readings on the economy. And I think that the economy got a lot slower during this banking crisis. Again, you don't just get your banking crisis, a bailout, and no after effects in the economy. And we're starting to see people have to react to that today.
So interesting to note. So November was the turning point for you for gold. Before then, when would you say was the last time you were bullish gold? I mean, do you come in and out of gold, or is it like years?
Well, I mean, we do the quads, right? So the economic quadrants to be long of gold. The two best ones are when you have either stagflation, like 2011, gold was hit its all-time high back then because you had what we call quad 3 or economic stagflation, or quad 4, which we currently have now, which is essentially disinflation or deflation. So we're like I always like to say, I go both ways. I mean, if we're in quad 2, where you have growth and inflation accelerating at the same time, that's when real rates are rising. That's when we're short gold. So we essentially went from short gold throughout 2021 to taking our time and then going full-blown gold bull starting in November. I went bullish on gold coming out of 2001 in the recession. I went bullish on gold coming out of 2008 in the recession. And now I'm coming to, so again, it's, if anything, and I make plenty of mistakes, I'm consistent in staying with my process. So what you'll find is, Danny, that the gold really likes it when you're in the second part, like phase 2 to phase 3 of a bear market. That's where it really starts to pick up its head. Of course, if you bought it in 2001, I mean, you didn't have to sell it until 2011. So these things can go on quite a run, and I'm in no hurry to get off this run.
Okay, and so how much of the fundamental picture are you also weighing on this? Like, again, going back to what the Fed will do, or central banks' record buying of gold, China keep adding to its reserves. I mean, are you taking any of this into consideration as well when you're for the gold story?
Yeah, we have, so in our macro presentation, we have the signal to quad setup, then we have the macro setup, and we have the fundamental setup. What I think is most interesting on the fundamental setup, so if you're just like a purist, I mean, we have plenty of analysts to do their bottom-up work, and I just pay attention to them and listen to them. I mean, the supply side of gold and the production side is arguably not been this good going back all the way back to 2001. So you have a very good supply picture. You have some M&A that's picked up, but not like on the order that we would say is the kind that, I really think it's going to be a race. And if you think about the last two gold cycles where CapEx was so depressed and production was still kicking at the right level and the gold price started to kick higher, you didn't have the same cost of capital inhibitions, right? Like Now, if you want to go start a gold mine, first of all, like I'm from Thunder Bay, Ontario, like north of me is where Red Lake is, or where where we found the good stuff. And it takes a while, like to find it and dig it out. It's like 7 years. So the cost of capital piece and the duration piece for these gold miners, it really becomes, I think, fundamentally a scarce asset, because it's going to be so hard to be able to borrow capital, borrow it with that duration of an investment horizon, and replicate the existing gold assets. So, for me, if gold's ever going to work, it should work big time now. Right. And if it doesn't, then anybody who's ever been bullish on gold should just like hide somewhere, because you just don't have a better
I'm out.
Exactly.
Okay, so because it's our first time speaking, Keith, I also want to get your thoughts on cryptocurrencies. I mean, is there a bigger case for Bitcoin now amidst all this bank run?
I think there was. I mean, cowbell or epic central planning. I mean, what is unwinding like 63% of quantitative tightening in like 2 weeks amongst friends? I mean, that obviously gave a bid to like magma stocks and the crypto, everything from Ripple to things that I don't think will exist. I mean, first of all, we haven't even regulated the entire crypto market, which is coming down the pike. Bitcoin, we do like to think of Bitcoin as a commodity, first of all. Just like any other commodity, it has price, volume, and volatility attributes that we can trade. We do go both ways on Bitcoin as well. In Quad 4, you want to be long gold and short crypto. It just so happened that crypto just had a big move with a lot of central market planning. And we have a daily crypto tracker, Danny. So what my risk range that we already discussed on downside in the S&P, the top end of that range is like just inside of 30,000 on Bitcoin. So yeah, it could go there, but it could also go straight back down to 27,000 and change, which is the low end of the range. So I'm expecting crypto to trade with the NASDAQ and actually fail here. We're not aggressively shorting crypto here because it's a little squirrely. I mean, the thing about crypto and the NASDAQ is that you got a lot of crazies. I mean, I wrote a note the other day it was literally called NASDAQ crazies. And I said, this is almost as crazy as like hockey parents, which is pretty crazy. So you have like,
if you're Canadian, you know.
You just know. It's that look. The nose on the glass. But like the crypto like crazies. I mean, you're damn right they'll take it to the top end of the range. They wouldn't know otherwise. They don't know what real rates are. They're certainly not modeling the economy. Now casting it like we are. I don't think they have a fine appreciation. Maybe they sit a little bit more in Janet Yellen's seat, like they think that the banking thing just kind of went away and they get to keep their cake and eat it too. So I'm like, for now, and we've been bearish on crypto going back to November, December of 2021. So I like to stay with our big macro calls for a lot longer than most people do. We call it our full investing cycle process, and I think it's important just to contextualize why crypto crashed, and most importantly, why you shouldn't chase it up here at the top end of my range.
Yeah, I know you had a lot of things to say during the FTX crisis. So, and I would invite anyone to Google that. But, when the downside risk to Bitcoin, because I've had some technicians on saying if it can't get to 30,000 here and hold 30,000, that they could see it go back down to 12.
Yeah, I mean, our trend, what we call our key trend signal. So we have risk ranges. That's the daily, immediate term range. But we have trade, trend, and tail signals. The trend is 3 months or more. It would have to get above 31,556 and close there and stay there with commensurate volume and a breakdown in volatility for my signal to change. The biggest problem with Bitcoin is that it has what we call uninvestable vol or uninvestable volatility. The level of volatility, even at this price, is nauseating. I mean, you cannot 50, 60, 70 vol does not a bull market make. And if Bitcoin volatility were to break down like the equivalent of the VIX towards like 40 or 30, then I would expect to see that the level 31,556 break out to the upside. But it doesn't look like it even wants to take a sniff at that level.
So I guess to wrap, because I know we threw a lot of information at the people at home. If you had to paint a picture for us right now, it was like you said, you've been covering the markets for quite some time. of, if you had to summarize the moment we're living in right now and how to navigate it, what would it be?
Well, I've called it the mother of all bubbles for 15 going on 16 months. And I'd say that behaviorally, like right now, the way that bulls are behaving epitomizes the mother of all bubble behavior. To think that we're going to go back and buy Bitcoin, NASDAQ, Magma, I think is absolute lunacy. Like, I think that this ends in tears at some point in the next 3 to 6 months. We didn't even talk about the debt ceiling. We have a clean line, like a clean line of sight on catalysts here that are very dangerous. Don't forget that the S&P 500 during the debt ceiling debate of 2011, when gold peaked last time, and by the way, that might be another reason why, Danny, gold's ripping, is that gold went to the all-time highs, and between April and August of 2011, the S&P 500 went down 20%. Like, that to me would be like, yeah, no shit. I mean, that could easily happen from here. And that's what I'm concerned about, is that not enough people learn their lesson in the bear market of 2022, and I think they're about to get a second part of that education.
Wow. And you mentioned the debt ceiling, so let's talk about it for a second here. And maybe we're not talking about it enough because we've heard about debt ceilings so many times in the past that we're like, oh, we've been there before and we know how this goes down and it just gets kicked down the road and everything is hunky-dory again. But is this time different?
Well, I'd say, everyone's going to have their own political opinion. I don't know anyone who is on the right side of sanity that would say that Republicans and Democrats are soon to fix each other's problems. That's not. No. We have Trump in New York today. This thing's going to get squirrelier faster. So on the political side, I think it's in the worst case scenario, it's as bad as it's ever been. And it could be a lot worse than that. Ever is a long time. Like my colleague and partner here at Hedgeye, his name's Neil Howe, who wrote, you may be familiar with the book called The Fourth Turning. Demographically, we're also in the fourth turning with this debt ceiling debate, where it's interesting. And I do think that actually from today's price, because the dollar's corrected, it's a good spot to actually come back to the dollar, because going to cash is a really appropriate move here when everyone, including the U.S. government, is going to be looking for liquidity. And one other point is, like, during prior debt ceiling debates, it's like you and I have been around long enough to know that you're right. Like, we get right to the wire and then we solve it and then everything goes up again. X 2011, where they went right to the wire and S&P all of a sudden is down 20% in a straight line April to August. So this time, the Federal Reserve is losing so much money each month. They're almost like the world's largest regional bank right now. They're upside down. And they're losing, like, we're trying to get to the number between 10, 12, 15 billion dollars the Fed is a month. Whereas even at last year, the Fed was handing Janet Yellen like 90 billion in profits, where she could use that. And that thing's flipped upside down. So she's in a real tough spot. That's probably why you started with the right comments, like that she's making these comments, they're political. And at some point, the chickens come home to roost. She herself said, right, June 5th or 6th that the government runs out of money. And you better believe that that's true.
Yeah. And who pays the price? If the Fed is losing this amount of money per month, who pays the price?
Yeah, it's gonna be fascinating to watch. We've tried so many times to pass it on to the people, and I think a lot of people, including myself, are disgusted with it. This most recent bank bailout, they did everything to not call it a bank bailout. Now you got a bunch of people running around, bull market's back. Powell's not going to like that. The bond market doesn't like that. I think we're actually this time, as opposed to the 2008 crash and crisis that I called, which was really a Wall Street thing. I think this is a Main Street thing. I think Main Street is going to be quite upset if there's an ongoing bailout of private equity, venture capital, and all that stuff.
I would think so. And then if there's some sort of revolt against that, what happens?
Yeah, that's where the value of the U.S. dollar historically has been. There's a lot of talk. I kind of think of it more like macro tourism, that the dollar's lost or is losing its reserve currency status. I think that is unequivocal bullshit. At some point, maybe in the future, but not going into this one. This is where the value of a dollar and gold and cash are quite valuable. So we'll have to see.
Well, wait, hold on. I was going to wrap the interview, but now I'm like, wait a second. Let's talk about your thesis because I have so many people coming on talking about de-dollarization.
Yeah.
We see the dumping of U.S. dollars, countries, the BRICS, turning their backs on the U.S. dollar, creating their own currency. So what's your take on that?
Well,
You're saying that the U.S. won't roll over, or I'm just fascinated to know your take.
Yeah, well, I mean, one that's not new. I mean, and you know, we've been bullish on the dollar since January of last year of 2022. So again, it's we would always start with quad four. So economic conditions, quad four, growth, inflation, and profits decelerating creates a huge creates a huge liquidity crisis. And being long of cash, whether it be cash flow or cash itself, I mean, it's all good and fine to just kind of bean count who's doing what in terms of, you know, issuing their own currency. But, you know, 85+% of global commodities, you know, settle daily in dollars. The world's paid in dollars, you know, particularly corporates. I mean, the value of dollars is obviously all across of all U.S. dollar denominated debt. So I'm at some point, and again, you know, my greatest fault is that I'm not as smart as all these people that come up with these grand theories. But I'm just going to stay with my signal. And if the dollar holds a higher low here, it remains, back to my process, it remains bullish trend, and it can go easily to 108 to 110 on the US dollar index. I don't think that it's a huge conceptual leap to get there. It's not the most wild and exciting thing, but last year it was one of our biggest positions, and it paid us handsomely. I haven't heard one of these people that are bearish on the dollar long term talk about how much dollar position or what their dollar short position was last year. I don't think that they really, you know, they just kind of come back when the dollar goes down for 3 weeks, which it just did after going up for 6 weeks. So I think the dollar is right at the spot where you buy it.
Keith McCullough, fascinating insights. Thank you for coming on. Like I said, Keith McCullough of Hedgeye and author of Diary of a Hedge Fund Manager. And I read this fun fact, which makes sense to me now, being Canadian, is why you were able to lead the men's Yale's hockey team to, what was it, Division League Championship during your time there. So that makes sense.
It's a long time ago. I can barely skate anymore, but thank you for that. I appreciate it.
But that makes sense. You would need a Canadian to be able to lead to such hockey greatness. So Keith, thanks so much for joining us. It was an absolute pleasure.
Thanks. It was a nice first opportunity to be with you. Thank you.
And thank you all for watching. Be sure to stay tuned to the Daniela Cambone Show and sign up at danielacambone.com to stay on top of it all. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.